All right, welcome to the deep dive. We got a request to really dig into group life insurance. Someone really wanted to understand this, but without getting bogged down in all the tiny details.
Yeah, so that's what we're going to do. Unpack this in a way that makes sense and is useful.
Exactly. And we've got a ton of great resources to draw on, so we should be able to get a really clear picture of what's important here.
Think of this as your personal guide to group life insurance. We'll cut through the complexity and give you the key takeaways you need to know.
Okay, perfect. So let's just jump right in. What exactly is group life insurance?
So at its core, group life insurance is a single life insurance policy that covers a whole bunch of people.
Okay, got it.
That's the big difference from individual life insurance, which, as the name implies, covers just one person.
Right.
Group life insurance is often offered as what's called annual renewable term life insurance.
Okay.
And you frequently see it provided by employers or like large associations to their employees or members.
So it's kind of a bulk purchase of protection?
Yeah, exactly. It's a way to get coverage for a whole group of people under a single policy.
Gotcha. So it's a different beast than, if I went out and got an individual policy on my own. What are some of the other big differences we should keep in mind?
Well, there are several key distinctions between group life insurance and individual life insurance.
Okay.
First, as we mentioned, the number of people covered. Group covers many, individual covers one.
Right.
Secondly, the type of policy is usually different. Group life insurance is typically that annual renewable term, meaning it renews each year, and the premiums can change.
Right. It's not like a 10 or 20-year term.
Exactly. Unlike a term policy you buy individually, that often has a set premium for a specific period, say 10 or 20 years, or even a whole life policy that lasts your whole life and could build cash value.
Gotcha.
Another big difference is how they decide who gets covered the underwriting process. With group life insurance, the insurance company looks at the characteristics of the group as a whole. Individuals usually don't have to go through medical exams or prove they're healthy enough to be insured, especially larger groups.
Right, right.
With individual life insurance, it's all about your personal health history, your lifestyle.
Yeah.
They're going to underwrite you specifically.
Okay, so more people, generally a renewable, shorter term feel in group plans, and they don't really dig into your health as much. What else?
Well, there's who owns the policy.
Okay.
In a group plan, it's the employer or the association that holds what's called the master policy.
Okay.
And the employees or members get what's called a certificate of coverage.
Okay.
That basically outlines their benefits.
Right.
With individual life insurance,
Hmm.
the person who is insured, they often own the policy, or sometimes it's owned by somebody else like a spouse or something like that.
Right, right. Okay, so you don't have that middleman with individual.
Exactly.
Yeah.
And finally, the paperwork is different. In a group plan, you get that certificate of coverage. With an individual plan, you get the full detailed insurance policy document.
Okay, so there's some pretty significant differences there.
Yeah.
And that really gives us, I think, a good foundation to now dig into how these group plans actually work in more detail. So let's talk about the core principles and characteristics of group life insurance, things you should be aware of.
So, like any insurance, group life insurance involves a contract between an insurer and a policyholder.
Right. The people selling the insurance and the people buying it.
Exactly. But here's the thing with group life insurance. The employer is often the policy owner.
Okay.
They're the ones who set up the plan, manage it with the insurance company, and the employee is really more of what's called a certificate holder. They're the ones covered, receiving the benefits outlined in their certificate.
Gotcha.
So while that basic idea of insurance, transferring risk is the same, the structure of the agreement has that kind of extra layer with the employer involved.
It adds a third party to the mix.
Yeah, in a way.
So the employer is pretty central here. They're a key player. What exactly are their responsibilities in all this?
They actually handle a lot. First off, they choose the type and amount of coverage they want to offer their employees.
Okay.
So they're the ones making those decisions.
Right.
They also manage all the record keeping associated with the plan
Uh-huh.
and handle the process of enrolling employees.
Right. So they take care of all the administrative stuff.
Exactly. And importantly, they need to make sure the plan doesn't unfairly favor certain employees, especially with what are called non-contributory plans, where the employer pays the entire cost.
Oh, okay. So there are rules about fairness in how these plans are structured.
Definitely. There are regulations in place. Think of it like this. The benefits should be available broadly across the workforce. You can't just offer a big life insurance benefit to the executives and nothing to the rest of the employees.
Right, it's got to be equitable.
Exactly.
So to just make sure we're all on the same page, can you quickly go over the key differences between group and individual insurance one more time, just to drive the point home?
Sure. So for underwriting, which is how they decide who's eligible, group plans look at the group as a whole, and individuals usually don't need to prove they are insurable.
Okay, yeah.
But individual plans require proof of insurability.
Right, they look at you.
Exactly. For policy ownership, the employer owns the master policy in a group plan. Employees get those certificates. But with individual, the insured person is often the owner.
Okay.
The policy type in a group plan is typically temporary, like we talked about, annually renewable term.
Yeah.
While individual plans can be either temporary or permanent.
Okay.
And then cost-wise, group insurance is typically less expensive for the insurer, and it's often subsidized by the employer, making it cheaper for you as the employee.
Got it.
While individual insurance is typically more expensive for the insurer, and the individual pays the full cost.
Okay.
So that there are those major differences.
Okay, so just one more time to make sure I'm getting this right. It's the certificate of insurance that I, as the employer, would have as my proof that I actually have this coverage, right?
That's exactly it.
Yeah.
The master policy is with the employer, but your certificate of insurance is your document.
Okay.
It outlines who's covered, the amount of coverage, the beneficiary you've named, all that important stuff. It's your key document.
Awesome. Thank you for clarifying that. Now let's talk about these contributory and non-contributory plans that our sources talk about. What's the difference, and how does that affect, the average person?
So this comes down to who's paying for the group life insurance.
Okay.
In a non-contributory plan, the employer pays the entire cost, 100% of it.
Right.
And because they're covering everyone who's eligible, the insurance company usually requires 100% of eligible employees to participate.
Oh, okay.
This helps the insurer avoid what's called adverse selection.
Adverse selection, what is that?
That's the tendency for people who know they have health issues or consider themselves higher risk to be more likely to sign up for insurance.
Oh, okay. So they're trying to balance out the risk pool a bit.
Exactly. The risk is spread out more evenly because everyone's covered. The big thing for you as the employee in a non-contributory plan is that you don't see any premium deductions from your paycheck.
Oh, okay. Interesting. So non-contributory is completely employer paid and everyone has to be in. What about contributory plans?
So in a contributory plan, the cost is shared. The employer and the employee both chip in.
Oh,
In these cases, the insurance company usually requires at least 75% of eligible employees to participate.
gotcha.
Again, it's that idea of managing adverse selection, making sure enough healthy people are in the mix.
So it's not quite everybody, but it's still a good chunk of the workforce.
Right, the majority. And in this case, as an employee, you would contribute to the premium,
Right.
usually through deductions from your paycheck.
All right, makes sense. So it's a split cost situation. Not everyone has to participate, but a good majority do. Now, this might seem like a basic question, but who can actually get covered under a group life insurance policy? What makes a group eligible to even have this kind of plan?
That's a good question, and there's a really important principle here. The group can't be formed just to get insurance.
What do you mean?
It can't be the primary purpose.
Yeah.
Like, you can't have a group of random people saying, hey, let's get together so we can get cheap life insurance.
Okay, so there has to be a legitimate reason for the group to exist in the first place.
Exactly. The insurance coverage has to be secondary, incidental.
Yeah.
It's a perk, not the main reason for the group.
Gotcha. So what are some examples of groups that are eligible for group life insurance?
Well, the most common one is a single employer, all the people who work for the same company.
Right, the classic example.
But it can also be multiple employers banding together.
Okay.
Maybe small businesses in the same industry.
Yeah.
Or it could be labor unions, professional or trade associations,
Okay.
groups of people who have credit or debit relationships,
Yeah.
like members of a credit union,
Interesting.
fraternal organizations, even what are called trustee groups.
Trustee groups.
Yeah, they're kind of special groups set up by two or more employers or unions to manage benefits for their employees.
Gotcha. So it's a pretty wide range.
It is.
Are there any other kind of rules or anything that make a group eligible or not?
Yeah, it's important to know that individual states can have their own regulations.
Oh, okay. So it's not just a federal thing.
Right, states can add their own rules. For example, a state might require a certain minimum number of people for the group to qualify for group life insurance.
Okay.
Or they might require the group to have been in existence for a certain amount of time before they're eligible.
So there could be some local variations.
Exactly. So while those categories we talked about usually qualify, you might find some additional rules depending on where the group is located.
Right. It's always good to check the specifics. So the group itself has to meet certain criteria. Now, what about the individuals within that group, say the employees? What do they need to do to be eligible for coverage under the plan?
Well, there are a few standard requirements for employees. Typically, they need to be full-time employees and actively working.
Okay, so not part-timers or people on leave.
Right. Usually that means they're not on long-term disability leave, for instance. And if it's a contributory plan where the employee pays part of the premium,
Right.
they'll need to agree to have those deductions taken out of their paycheck.
Makes sense.
A lot of plans also have what's called a probationary period for new hires.
Okay.
Often it's 1 to 6 months before their benefits, including life insurance, actually kick in.
So you have to be there for a bit before you get the perks.
Exactly. It's like a waiting period. And then finally, once they become eligible, there's usually a specific enrollment period,
Okay.
which is often like 31 days when they first become eligible to sign up for the coverage without needing to provide proof of good health.
So you've got a window of opportunity to jump in.
Yeah, if you miss that initial window, you might have to go through medical underwriting to get coverage later on.
Interesting. That all sounds pretty standard.
It is.
Now, I want to think about the insurance company's perspective for a minute. How do they assess the risk when they're covering a whole group of people like this? What are the underwriting requirements for group life insurance? It can't be the same as when you apply for an individual policy,
This is
right?
absolutely right. It's a different ballgame.
Okay, good.
The main goal of underwriting for group life insurance is to minimize adverse selection.
Right, we talked about that a little bit. That's where people who think they're more likely to need the insurance are more likely to sign up, right?
Exactly. And insurers want to avoid having a disproportionate number of high-risk people in the group.
So how do they manage that when they're potentially dealing with hundreds or even thousands of people without doing individual medical exams on everyone?
They rely heavily on the law of large numbers.
Okay, the law of large numbers, what's that?
It's a statistical principle. Think of it like this. If you insure a big enough group of people, the overall risk becomes more predictable. It's like flipping a coin. If you flip it a few times, you might get a bunch of heads in a row. But if you flip it hundreds of times,
You get closer to a 50-50 split.
exactly, it evens out. With a large group, the insurer can kind of statistically predict, about how many deaths they expect to occur within that group each year.
Oh, okay, interesting.
And that's why, for larger groups, they usually don't require that individual proof of insurability.
Got it.
They don't need medical exams, that kind of thing.
Yeah.
But for smaller groups, it can be different.
Oh, so size matters. Why is that?
Well, with a smaller group, that predictability goes out the window.
Okay.
The impact of a single death claim becomes a lot bigger for the insurer.
Right, because it throws off their calculations more.
Exactly. So imagine you have a group of 500 employees. The insurer can reasonably estimate how many claims they'll get each year. But if it's a group of just 10,
Yeah, one death claim is a much bigger deal.
right, it could be like 10% of their expected payouts.
Yeah.
So in these cases, they might require some health information or proof of insurability from individuals to better understand the risk.
So they need more information to feel comfortable. Our sources also mention something important, that employees with physical impairments can't be excluded from the group plan.
Right.
That seems really important in terms of fairness.
Absolutely. It is. Generally, group life insurance plans cannot exclude eligible employees just because they have a physical disability,
Right.
like paralysis or something like that.
It's about equal access to coverage.
Exactly. It's a key part of non-discrimination in group insurance.
That's good to know. And then the last thing on underwriting, how long a group stays with an insurance company. Our source called it policy persistency, whatever that means. I guess insurers care about that.
Yeah, they do. Policy persistency just means how long a group keeps their insurance coverage with a particular insurer.
Okay.
And insurers, well, they prefer groups that have good persistency, meaning they don't switch companies all the time.
Right. Because it's a hassle to get new customers all the time.
Exactly. There are costs involved in acquiring a new group, setting up a new policy. So if a group keeps jumping ship every year.
It's seen as riskier and less profitable.
Yeah, exactly.
Okay, so to sum up, insurers look at the overall health of the group. They rely on those big numbers to kind of balance out the risk. They usually don't need individual health checks for the big groups. They can't exclude people based on disability, and they like it when groups stick around. Got it.
A good summary.
Now, once the insurance company has all this information about a group, how do they actually categorize the risk?
So they'll typically classify the risk level.
Okay.
They might have tiers or categories, something like that.
Like, are there good risks, bad risks? What are we talking about?
Exactly. Good risks and bad risks. So you often see categories like preferred risk.
Okay.
That's for groups that are seen as very low risk.
Okay.
And they'll usually get the most favorable premium rates, the lowest cost.
Hmm.
Then there's standard risk, which is considered average. And these groups don't usually have any extra charges added to their premiums. But if a group, or maybe some of its members, are considered substandard risk,
Meaning higher likelihood of claims.
right, then the premiums will be higher to compensate for that increased risk.
Makes sense. You got to pay more if you're riskier to insure.
Exactly. And then in the most extreme cases, if the potential for a loss is just too high, the insurer might decline to offer coverage at all.
Oh, wow. So they can just say no.
Yeah, in some situations, they might determine the risk is too great for them to take on.
Okay, so lower risk equals lower premiums. And if the risk is too high, they might not get covered at all. That's a pretty straightforward way to think about it. Now let's talk about some of the cool features that often come with group term life insurance. The conversion privilege sounds really useful. Can you explain what that is?
The conversion privilege is a great feature for employees.
Okay, good.
It gives them the option to convert their group term life insurance into an individual life insurance policy if they leave their job.
Oh, so even if you're not with the company anymore, you can still keep some coverage going.
Exactly. So whether you're laid off or you decide to quit, this privilege lets you keep some life insurance.
Okay, so you don't just lose your life insurance automatically when you leave the company.
No, you have a way to continue it.
That's great.
And the really important part is you don't have to provide proof of insurability.
Oh, wow. So no medical exams, no health questionnaires, even if your health isn't as good as it used to be.
Right, which could be a huge benefit if your health has changed since you first got the group plan.
Yeah, because you might not qualify for an individual policy on your own at that point.
Exactly.
That's a real lifesaver. So is there like a time limit on when you can use this conversion thing?
Yeah, there is. You typically have 31 days after your employment ends to convert.
Okay, so you have to act quickly.
Right, you can't wait too long. But here's an interesting thing. If you pass away during that 31-day period, even if you haven't converted yet, the death benefit would still be paid out under the original group policy.
So you're still covered during that transition period, even if you haven't done the paperwork yet.
Exactly. You have that peace of mind.
That's good to know. And you mentioned before that the premium for the new individual policy is based on your age at the time of conversion, right?
That's right. It's based on your attained age.
Which means it'll probably be higher than when you were younger and healthier.
Yeah, that's something to keep in mind.
What happens if the whole group life insurance policy gets terminated?
Okay, so that's a good question.
Say the employer decides to go with a different insurance company or maybe just get rid of the benefit entirely.
Right. Well, many group policies have a provision that if the whole master policy is terminated, anyone who's been insured for a certain length of time,
Okay.
often at least 5 years, is allowed to convert their coverage to an individual policy,
Oh, okay.
up to the amount they were covered for under the group plan.
So even if the whole thing goes away, you might still have some options. All right, that's good to know. Now let's move on to something that's always top of mind for people when it comes to life insurance. You know, if something were to happen to me, who gets the money? And that's the beneficiary selection, right?
Right.
Our source mentions something called incident of ownership, and I'm not quite sure what that means.
So incident of ownership basically refers to the rights and control you have over a policy.
Okay.
So even though the employer owns that master policy and they have certain rights related to the plan, they don't get to decide who the beneficiary is.
Oh, okay.
That right belongs to the covered employee, the certificate holder.
Gotcha.
They get to name and change the beneficiary.
Okay.
That's considered an incident of ownership.
Right.
So it's ultimately the employee who decides who will get that death benefit.
Makes sense. Can an employee name like their employer as the beneficiary? That seems kind of weird.
They can, but there's a catch.
Okay.
The employer has to have what's called an insurable interest in that employee.
Insurable interest. Okay. Meaning what?
Meaning they would suffer a real financial loss if that employee were to pass away.
Oh, so it can't just be any employee.
Right. It has to be someone whose loss would actually hurt the business financially.
Okay. Makes sense.
So a company might have an insurable interest in a key executive, someone with unique skills that would be really hard to replace.
Right. I get.
But they wouldn't typically have an insurable interest in a, like, part-time administrative assistant.
Right, because they could just hire someone else.
Exactly. The idea is to prevent situations where an employer could potentially profit from an employee's death without a legit reason.
Yeah, it's got to be ethical.
Exactly.
Okay, and then there's this assignment provision that our source mentioned. Is that like a standard thing?
So in some states, group life policies can include what's called an assignment provision.
Okay.
And this basically allows the employee, the certificate holder, to transfer some or all of their rights under the policy to someone else.
Okay.
But it's not automatic. It has to be in writing and officially filed with the insurance company.
So it's more of a specific thing you have to do.
Exactly. It's not a default feature. So it depends on the plan and state rules.
Okay. So those are some of the key features we see with standard group term life insurance.
Yeah.
But now I want to talk about some of the other forms of group life insurance that are out there. Our source mentioned group credit life insurance. What's the purpose of that?
So group credit life insurance is designed to pay off a borrower's loan if they die before it's fully repaid.
Okay, so like if you have a mortgage and you pass away, the insurance pays off the rest of what you owe.
Exactly. That's the idea. It protects both the lender and the borrower's family.
That's a good thing.
Yeah, and you often see these policies offered by banks, credit unions, finance companies when you take out a loan.
Okay.
Could be a mortgage, a car loan, that kind of thing.
Mm-hmm.
The premiums are usually calculated based on the group's claims experience
Okay.
and other factors, and they're typically paid by the borrower. And a lot of times, these are decreasing term policies, meaning the amount of coverage goes down over time as you pay off the loan.
That makes sense. You don't need as much insurance as the loan balance gets smaller.
Exactly. It's tailored to the loan itself.
Okay, now what about blanket life insurance? That sounds kind of mysterious.
Blanket life insurance is different.
Yeah, it's not a very descriptive name.
Right. It covers groups of people who are all exposed to the same specific risk or hazard.
Oh, okay.
So think of passengers on an airplane
Right.
or students at a school.
Oh, okay. So
Right.
everyone in a particular situation.
Right. And nobody's specifically named on the policy, and you usually don't get individual certificates.
So it's just a blanket of coverage for that event or location or whatever.
Exactly. And the coverage only applies if something happens due to that specific hazard.
Okay, so it's very targeted short-term coverage.
Exactly.
Makes sense. All right, now let's talk about life insurance for people in the military and federal employees.
Okay.
These are obviously really important groups to make sure are taken care of.
Absolutely. And the government has specific programs for them. So there's Service Members Group Life Insurance, also known as SGLI.
SGLI?
It offers a lot of coverage to active duty military personnel.
Okay.
Right now, it's up to $400,000.
Wow, that's a lot.
It is. It's a group term life insurance policy, and everyone who is eligible is automatically enrolled unless they choose to opt out.
Oh, okay. So it's kind of the default coverage.
Exactly. It's there to protect them and their families.
What about families?
So there's actually a separate program for them called Family Service Members Group Life Insurance,
Okay.
or FSGLI.
FSGLI, got it.
And this provides coverage for spouses and dependent children of those covered under SGLI.
So it extends that protection to the family.
Exactly. And spousal coverage is automatic up to a certain amount, or the service member's coverage, whichever is less. And the premiums are based on the spouse's age. Dependent children get a set amount of coverage at no cost to the service member.
That's great. So it's really comprehensive coverage for military families.
It is. It's designed to give them peace of mind.
What happens when a service member leaves active duty? Do they lose their insurance?
Well, they can convert their SGLI coverage to what's called Veterans Group Life Insurance, or VGLI.
VGLI, okay.
Which is a renewable term life insurance policy.
So it's a way for them to continue coverage after they leave the service.
Exactly. And both service members and their spouses can convert their SGLI or VGLI coverage to permanent life insurance policies.
Oh.
Through certain commercial insurance companies without having to prove their insurability.
So they might have options even outside the government program.
Exactly. Which is great for people who might have developed health issues while they were serving.
Absolutely. Now, what about other federal employees, not in the military?
They have access to the Federal Employees Group Life Insurance Program, or FGLI.
FGLI, got it.
Which is a separate program offering group term life insurance.
Okay.
And it covers civilian government employees. It's a really important benefit for a lot of federal workers.
Okay, so we've talked about different types of group life insurance, how they work, who they cover. Now let's get to the nitty-gritty, something that's always important to consider. Taxes. How are these plans treated for tax purposes?
Taxes are always important, right?
Absolutely, never fun, but we gotta know.
So for these group life insurance plans to get favorable tax treatment, they generally have to follow certain rules. They can't unfairly benefit the higher-ups in a company.
Yeah, you gotta make sure it's fair.
So when it comes to the premiums, if you're an employee paying your part of the premium,
Uh-huh.
those payments are usually not tax deductible for you.
Okay.
But any premiums that your employer pays are usually tax deductible for them as a business expense,
Okay.
as long as they meet certain IRS requirements.
Right, of course the IRS always has rules.
But there's one exception to that deduction rule. Sole proprietors and partners in a business usually can't deduct the premiums they pay for their own group life coverage
Why is that?
because they're not considered employees. In that context, it gets a little tricky.
Oh, that's right.
And then there's the value of the coverage that an employee receives.
Right, like how is that taxed?
The good news is the cost of the first $50,000 of employer-provided group term life insurance is usually tax-free for you as the employee.
Oh, okay, so there's a threshold.
Exactly. But if your employer provides more than $50,000 in coverage, the value of that extra coverage,
Okay.
that's considered taxable income.
Oh, even though you're not actually getting the cash yet.
Right. It's kind of like they're giving you a benefit. The IRS wants their cut. They have this table to figure out that imputed income.
Imputed income, yeah, that's always fun.
It'll usually show up on your W-2.
Great. Something else to look forward to at tax time.
Exactly. So employers often structure their plans based on salary, job level, or they might just offer a flat amount of coverage to everyone.
So there are different ways to do it.
Yeah, it just depends on the company and the plan.
Okay, what about when the benefit actually gets paid out?
You mean the proceeds?
Yeah, the money from the policy. What happens tax-wise when that goes to the beneficiary?
So generally, if the proceeds are paid out as a lump sum to your beneficiary, it's federal income tax-free.
Okay, so that's good.
But if the beneficiary chooses to get paid in installments over time,
Okay.
then any interest that builds up on those installments is taxable.